All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Thursday, everybody. Today's July 25th, 2024. And guys, there are some mornings where Mish and I have our conversation every morning around 8 o'clock when we're struggling to put a show together because there's just not a lot happening in the world. Today is definitely not one of those days. I didn't know what was going to be the top story today because there's 3 or 4 competing right now that every single one of them deserves a headline. But let's going to start with the one that I think is most likely to fly beneath the radar of the mainstream, and that was New York Community Bank. They just posted earnings, and they sucked. Well, remember New York Community Bank earlier this year? They were on the chopping block. They bought up a lot of the assets from failed Signature Bank back in last year during the banking crisis. And then they started to report accounting irregularities, and they started to take a lot of losses tied to offices and to rent-controlled multifamily residential buildings in New York City. And it looked like right as the bank was about to fail, Steve Mnuchin, along with a couple of other Republicans, which was a little weird, came in and infused $1 billion, basically bought up the bank for $1 billion, rescued it, the stock rallied, and it's kind of fallen by the wayside ever since. And I remember saying back then, this story is not over. Based on the size of this bank, the amount of positioning that they have in their commercial real estate portfolio, and at the rate they were losing money, that $1 billion had bought them about a year. And well, I think maybe that estimate may have been too generous because here we are about 3 months later, and they've already burned through a third of that cash. They posted a massive loss today tied to office and multifamily commercial real estate, exactly what we've been talking about. That stock is getting crushed ahead of the opening bell. They're also selling off a big chunk of their business, trying to raise even more capital. I don't know. That bank, I'm not sure they're going to make it despite the big cash infusion. We've also got a big rally going on in the yen. It's given back some of that loss or some of those gains in just the last few minutes here because of the GDP story, which we'll get to. That's another big one. But over the last 15 days, the Japanese yen has strengthened from 161 yen to the dollar all the way down to 152 yen to the dollar. In 15 days, the currency of the world's third largest economy has rallied immensely against the dollar. Now, a lot of that was triggered by the intervention from the Japanese finance ministry that they very suspiciously timed some of their currency intervention with a lower than expected inflation print in the United States a few days ago. But then yesterday, it just started going on its own. There was no intervention from the finance ministry. The BOJ didn't do anything, and the yen just started to strengthen like crazy yesterday. And it looks like the much anticipated unwind of the yen carry trade may be getting underway very early, a little early maybe to say that's what's happening outright, but that's what they're calling in the press. And guys, that's important because we have no idea how big this problem is. It may be $1 trillion in size. The amount of yen that were borrowed and then converted to dollars, and then that money used to buy U.S. assets or assets in any other country, mind you, because it's been so cheap to buy yen and the yen has been constantly getting weaker. A lot of people have just been borrowing yen blindly and pumping the money into assets. Well, now the yen is strengthened. So all those people who are short the yen are getting squeezed. They're having to sell their assets, convert them to dollars, convert back over to yen, and then cover their yen shorts. And that could have amplified yesterday's big sell-off in tech. And, well, let's talk about that. Yesterday, the NASDAQ lost 655 points. That's the worst day since 2022, the last time tech was selling off like crazy. A 3.6% move led by AI stocks because the market is starting to call bullshit on all these ridiculous promises that have been made by the hucksters and the snake oil salesmen who are pumping artificial intelligence. Yesterday, Google just said, well, hey, you know what? We're not making any money off of AI. We're probably not going to make any money off of AI anytime soon, but we did just burn $13.5 billion on AI infrastructure, and we're going to keep burning about $12 billion a quarter just because everybody else is. That's pretty much what they said. They said the danger of underinvesting is worse than the danger of overinvesting. In other words, all my friends are jumping off of that bridge, so I'm gonna too. And then Elon Musk comes out and says, well, my electric vehicles aren't selling that well, but we're going to have humanoid robots any day now and self-driving robo-taxis, which he's been promising for years. And finally, investors are starting to say things like humanoid robots. Guys, this is what the hell are we talking about here? Are we really buying this garbage? Do we really believe this? I get it. It's the 2020s and the masses are unbelievably gullible. But when the guy says humanoid robots are going to be the next big thing, finally, some people are calling BS on this. And so that had the market doubting the entirety of the AI trade. And so AI stocks started to sell off like crazy yesterday. And I believe that tech sell-off may have been partially influenced by the strengthening of the yen. I think people who were short the yen and used it to buy U.S. risk assets saw the writing on the wall and they just got out. So that's the three big ones. Then we've got GDP just came out. The first estimate, the advanced estimate of second quarter GDP came out, and it was a huge beat, 2.8% economic growth in the second quarter, led by a sudden surge in consumer spending. Inexplicable. Consumer spending swung massively. And I'll be honest with you, I'm highly, highly skeptical of these numbers this morning. Look, it's only a few minutes old, this report. I haven't had a chance to really parse it, but everything I've seen, all of the consumer products companies that are out there are reporting terrible numbers, especially in North America. So where did all of this consumption suddenly come from? I don't know. Highly skeptical of these GDP numbers this morning, but it was a big beat, and so the market is reacting to that. We also have gold and silver getting crushed this morning, clobbered. It started last night around 10, 11 p.m. Eastern time, right as things were starting to get underway in China. Gold and silver selling off big here. Guys, between the unwind of the yen carry trade, New York Community Bank, there's this weird repo thing going on in Canada. Liquidity is getting scarce over there. Gold and silver selling off. Bitcoin is selling off. Somebody's blowing up somewhere. I don't know what's going on, but I see a lot of things moving in a lot of different places, and all of them are screaming somebody desperately needs cash. Everywhere except the bond market, where yields are falling strangely. So some unusual things happening in the market this morning. Also, American Airlines cut their profit forecast again. That's the second time in 3 months they did that. They're lowering fares. We got a little bit of consumer deflation going on in airline prices. And Hasbro actually posted better than expected earnings. That was unusual. Their digital gaming business is starting to surge, offsetting a decline in their core business, the selling of physical toys. We have a lot of stories to talk about this morning, guys. It is a very busy morning. Let's shrink my big melon of a head and see what's happening in the market, shall we? And guys, don't forget the like button and the subscribe button for the algorithm, because we do this every morning. So come have your coffee with the melon heads. Right now, the S&P is barely positive. I went with the bull thumbnail this morning because when we posted the live stream, all three indexes were just barely positive. S&P right now is up 2.8 points or 0.05% higher. Excuse me, just real quick, guys, I wanted to look at the big sell-off that we saw yesterday. This is the S&P chart showing Wednesday's move. Thursday hasn't showed up yet. Notice that we stopped pretty much right on the 50-day moving average for the S&P 500. Important technical level there. Watch what it does here today. Moving on, we've got the Dow is down 34 points this morning, or 0.09. I'm sorry, the Dow is up 34 points in the black here, in the green, 0.08% higher. The NASDAQ, meanwhile, is also up 19 points. It was negative a few minutes ago, but 0.1% higher for the NASDAQ. Look, 20-point gain after losing 655 yesterday. I'm not going to get too excited about that one. Take a look at the sell-off where the S&P held its 50-day moving average yesterday. The NASDAQ broke right down below it. Didn't even bat an eyelash at that 50-day moving average. We'll see what it does today. Does it recover that level? I would add, we saw a similar sell-off back in April where we gave up the 50-day moving average, got pretty well on our way down towards the 200, and then the dip buyers came in and took us right back up. Is that going to happen again? I don't know. It's probably going to depend on the big tech earnings. We've still got Amazon, Microsoft, and NVIDIA are going to report. And I think as NVIDIA goes, so goes the entirety of the market. So I'm still not getting too excited about this sell-off. Want to see what the market does in response to those NVIDIA earnings first. Meanwhile, the U.S. dollar is a little bit weaker this morning, down 6 basis points to 104.33. We did see a pretty sudden strengthening of the dollar at about 8.40. That was a few minutes after that GDP estimate came out. And then, of course, we're starting to see that weaken again here. Looking over at the bond market, we got yields are mostly lower. The 30-year Treasury, 4.510. That's down almost 4 basis points. The 10-year, 4.252. That's down 3.5 basis points. The 2 years at 4.408, down almost 1 point. And the 1 month is at 5.378, pretty much unchanged. The 10-2 inversion, guys, is down to less than 15 basis points, 14 points and change here this morning. Yield curve is slowly starting to uninvert, and historically, that is when the fireworks start, shortly after that first uninversion and shortly after that first rate cut, both of which are expected pretty soon here. And looking over at commodities, it is not a good time to be in commodities this morning. Spot gold, $2,374. That's down about $23 here, or 1% lower. Most of that happened during Asian hours last night. Check out spot silver getting crushed here. $27.70 for spot silver, down $1.19, 4% lower. We'll look at the silver chart in just a minute here. We've got September copper futures are up about a penny this morning. Platinum October futures down 2.9%. September palladium futures down 3.6%. And crude oil selling off too, down 1.12% for September WTI futures. Guys, the commodities market is screaming recession here. Especially that oil price down and another 90 cents here into the mid 70s for oil. Now take a look at the silver chart, and guys, this one is ugly this morning. That red line there, that is that $28.30 resistance level. That was the high back during the silver squeeze. That's a level we failed to break through several times. I got super excited a few months ago when we broke above that. Well, we fell right back below it yesterday. Here, we're still looking at 1 hour candles. Let's set this to 1 day candles. There we go. Unfortunately, we lost that key support level there. Next support, probably around 26.5 here, 26.25. Silver needs to catch a bounce real fast here. Not looking so good. And shout out to Baije Jun. That is the @Oriental Ghost on X. He posted this one here. The Shanghai silver price is at $31.05. So we're still looking at about a $3 arbitrage between U.S. and Chinese prices here. But this sell-off, let me switch this back to hourly candles, and you can see here when that sell-off actually took place. So this is going back to the last couple of days. You can see we were selling off pretty hard as it was, but then last night, right around looks like about 8 p.m. Eastern time is when the majority of that sell-off took place. That was when the Asian markets were open, continuing again here this morning, though. So not looking so good for the shiny. Also not looking so good for Bitcoin at the moment. Bitcoin is at $64,000 on Coinbase, down another $1,300 this morning, 2% lower, right around its 50-day moving average, 4 consecutive red days for Bitcoin also. Now let's get to the main story this morning, guys. New York Community Bank stock drops on steeper than expected losses on office and multifamily loans. This banking crisis at NYCB, it is not over. That billion-dollar cash infusion from Steve Mnuchin and co., it just bought them time, and that time is ticking off. And they're also selling one of their units, their mortgage service business, for $1.4 billion, trying to raise some more capital and buy themselves some more time. New York Community Bancorp stock fell 6% in pre-market trading after the lender reported a second quarterly loss of larger than expected charge-offs, mostly on office and multifamily property loans that it doesn't expect to be paid back. Separately, the bank announced the sale of its Flagstar unit's mortgage service business to Mr. Cooper for $1.4 billion in a move to strengthen its balance sheet. New York Community Bank's second quarter provision for credit losses grew to $390 million from $49 million a year ago and above the first quarter figure of $315 million. So even though they got that billion-dollar cash infusion, the losses are still piling up. They're increasing those credit provisions to $390 million. This is not that big of a bank, guys. That is a huge credit loss they're getting ready for. The provision reflects an increase in charge-offs, principally office loans, and the continuing impact of market conditions on the multifamily portfolio as higher interest rates and inflationary impacts persist. In other words, all the problems that were killing this bank back in February and March, they're still there. New York Community Bank said its charge-offs grew by $349 million. That's up from $81 million in the previous quarter. So not only are the problems still there, the problems are getting a lot worse. They went from $81 million in charge-offs to $349. And a charge-off is when they just say, these guys are not paying us back. We are taking the loss. It's not a provision where they say, just in case they don't pay us back, we're setting the cash aside. Once they charge it off, that means it's gone. It's not happening. The estimate from FactSet was for $90 million, so it came in at $349. This bank owns some garbage assets. The bank said it lost $333 million, or $1.14 a share in the second quarter, after posting net income of $405 million, or $1.66 a share in the year-ago quarter. In the first quarter, the bank's loss was $335 million, or $1.36 a share. So, that billion-dollar cash infusion, they're losing $335 million a quarter. That $1 billion is going to be gone in 3 quarters, guys, not even a year. Adjusted loss for the 3 months ended June 30th was $1.05 a share, below the analyst estimate for a loss of 40 cents. And revenue fell 44% to $671 million. Guys, they lost $333 million on revenue of $671. This bank is nowhere near profitable. These problems are not going away anytime soon. New York Community Bank stock getting absolutely crushed this morning, down 15.6%. That's after losing 5% yesterday, trading at $9.23. Although I would add, guys, things have been a little bit worse. This stock was down around $6 in April. So not quite as bad as things were since, as far as share price goes. But a big chunk of that money that they raised from Steve Mnuchin, it's already gone. They just raised another $1.4 billion by selling off what little profitable businesses they have left. Things are not looking so good at this bank. I don't think this bank is going to be around this time next year, not without another rescue. Also going on, this one was from yesterday. The yen surges as traders bet the big turning point is finally near. Shout out to Michael Gayet on X at Lead Lag Report. He has done a fantastic job documenting what's the risk of the unwind of the yen carry trade. He's been calling it for, at least that I've noticed, at least about a year. It looks like it may finally be getting underway, and this could play a big role in U.S. stock prices. Signs of an inflection point for the yen are mounting amid growing expectations that the interest rate gap between Japan and the U.S. is finally set to shrink. The currency rallied more than 1% on Thursday as it extended its sharp rebound over the last 2 weeks from the lowest level against the dollar since the 1980s. The advance has been spurred on by Japan's apparent intervention to support the yen, a slashing of bets against the currency by hedge funds, and the unwinding of global carry trades that have been weighing it down. Whether the advance that's roiling markets now proves to be a turning point will likely come down to the decisions next week of the Bank of Japan and the Federal Reserve. Some 90% of BOJ watchers see the risk of it hiking rates on July 31st, even if that is not their base case outcome. And the Fed is facing growing calls to start cutting its rates on the same day. This certainly looks like positions coming off ahead of a possible rate hike in the face of some much better timed intervention, said Kit Joux, am I saying that right? Chief FX strategist at Societe Generale. These are sizable moves, and this pushes up volatility. And as volatility goes higher, the cost of holding the position gets bigger, so it has a capacity to unravel. And take a look at the chart of the yen here. This is USD JPY, the number of yen it takes to make a dollar. And this thing has just been in free fall for the last 15 days. Now, yesterday we had this big red candle here. There was no intervention yesterday. That was all just speculation about the unwind of the carry trade. That was continuing this morning. We got as low as 152 yen to the dollar. And then that stronger than expected GDP number came out, and the dollar rallied against the yen when that happened. So the yen has bounced off of that low, which coincidentally was right around the 200-day moving average there. So keep an eye on the yen, guys. This has a very strong potential to affect U.S. equity prices. I think this probably played a role in that bloodbath in tech that we saw yesterday. Maybe it didn't cause it, but it certainly amplified the move. And this is one to keep an eye on. We got the BOJ is getting together later this week, so we'll see if they hike interest rates and by how much. Speaking of that tech sell-off, $1 trillion rout hits NASDAQ 100 over AI jitters in the worst day since 2022. What took you so long? I've been warning about this for over a year. Is it finally starting? I don't know. But investors soured on the promise of artificial intelligence on Wednesday, sparking a $1 trillion rout in the NASDAQ 100 index as questions swirled over just how long it will take for the substantial investments in the technology to pay off. I might add, if ever it pays off. The NASDAQ index has tumbled more than 3% for the worst days since October of 2022. The list of laggards was a who's who of AI tech darlings, led by semiconductor companies such as NVIDIA, Broadcom, and ARM Holdings. The sell-off was triggered by a middle-of-the-road earnings report from Alphabet late Tuesday that featured a bloated capital expense. The company's stock sank more than 5% for its worst performance since January. Tesla plunged more than 12% after CEO Elon Musk offered scant details about his company's self-driving vehicle initiative. The overarching concern is, where is the ROI on all of the AI infrastructure spending, said Alex Young, chief investment strategist at Map Signals. There's a pretty insane amount of money being spent. Maybe it'll pay off in a few years, but I think investors realize that the payoff is going to take time to materialize, and the hyperscalers' earnings are being hurt in the short term by how much they're spending on it. In other words, AI doesn't make money. It's just this big, giant toilet that they flush billions of dollars down just so they can say how many GPUs they own. Phase 3 profit. In between, there's supposed to be a whole business that provides a service or a product that people will pay for so that the company can make money. But it doesn't happen. All it is CEOs bragging about how many GPUs they're buying. And then Jensen Huang, when he's not signing boobs, is out making stupid speeches about how it's the next big thing. It's going to put everyone and their brother out of work, and countries need to buy it. Everybody needs to buy data centers. And look at my stupid motorcycle jacket. People are finally starting to ask questions. Hey, does any of this crap make money? And the answer right now is unequivocally no, it does not. Moving on from that one, guys, we got GDP surprise this morning in a big way. The U.S. economy expanded at an annualized 2.8% rate in the second quarter. That's up from 1.4% in the first quarter, a huge spike in growth, and above market forecasts of just 2%. That's according to the advanced estimate that just came out this morning. Consumer spending rose faster, 2.3% versus 1.5%. And guys, that's it right there. I mean, consumer led by a resumption in the consumption of goods, which rose to 2.5% from negative 2.3%, while services slowed a little bit to 2.2% growth from 3.3%. But where did all of this consumption come from, guys? Everything I have seen has shown that consumers are out of money. They're in debt. Well, maybe I just answered my own question. It's debt. But a big surge in the consumption of goods from negative 2.3 to positive 2.5 in one quarter. That is a massive swing. Where is all of this money coming from? And consumption is about 70% of GDP, guys. So that's where it came from right there. Consumers are forking over money for goods. I don't know what it is. It's certainly not airline fares. It's certainly not vehicles or smartphones. Whatever people are spending money on, it's causing GDP to grow. Also, private inventories added 0.82 percentage points to the growth after being a drag for the past two periods. Meanwhile, non-residential investment accelerated 5.2% versus 4.4%. Equipment was 11.6% versus 1.6%, while intellectual property products fell to 4.5% from 7.7%. Let's see. Investment on structures sank to negative 3.3 from 3.4. So we got a slowdown in building. General government spending increased more, 3.1% versus 1.8%. So the government's juking the number a little bit higher there as well. On the other hand, residential investment contracted for the first time in a year, negative 1.4% versus 16%. So a big contraction in residential fixed investment, and net trade dragged down the growth for a second consecutive quarter as imports rose faster than exports. Despite the increase in the second quarter, GDP growth fell below the average quarterly rate of 3.1% from 2021 to 2023. So, guys, GDP growth really surprising. We were expecting 2%. It's up from 1.4% to 2.8%, being largely led by some very mysterious surges in consumption of goods that I just can't explain because it doesn't jive with any of the data that I've been seeing from any of these consumer companies reporting earnings. And speaking of consumer companies reporting earnings, American Air cuts profit outlook as fare sales hurt carriers. There's another one here, another airline saying, guys, these cheap airfares are killing us. American Airlines Group slashed its earnings outlook for the quarter and for the full year, making it the latest carrier to temper expectations as industry-wide fare discounting and high costs squeeze earnings. Adjusted 2024 profit will be 70 cents a share to $1.30, far less than the earlier outlook for $2.25 to $3.25 a share. They're not just cutting their profit forecast a little bit, guys, from $3.25 a share to 70 cents a share. Massive cut here, the carrier said Thursday in a statement as it reported second quarter financial results. It expects to break even in the third quarter, well short of analysts' expectations for 49-cent profit. The carrier shares tumbled 7.3% before regular trading in New York. Cut rate ticket prices have become the latest hurdle for U.S. airlines, already wrestling with delayed deliveries of new planes and rising labor costs. Although discount carriers have been blamed for slashing fares after adding too much flying capacity, American's own aggressive discounting risks eroding its second half results. That's according to Thomas Fitzgerald, the TD Cowen analyst, said in a report earlier this month. With the cut, the Fort Worth, Texas-based airline has now lowered expectations twice this year. CEO Robert Isom in May acknowledged that the carrier had misjudged domestic demand, forcing it to slash second quarter profit and revenue expectations. And the company also fired its chief commercial officer, who had led changes to American's network and corporate sales strategy that drove away lucrative business customers. American Airlines down 2.56% here this morning after falling almost 3% yesterday, trading at $9.94. That's down about a quarter this morning. We also got earnings from Hasbro. Hasbro profit beats Wall Street estimate as digital gaming business grows. I'm not going to spend too much time on this one, guys. This was kind of interesting, though, because Hasbro is one of those consumer products companies that's really been hurting. Toy sales just aren't what they used to be. People are buying much fewer toys here. We're seeing that in Hasbro's earnings report. Their core consumer product sales were down about 20%. But Hasbro is also seeing a big surge in its gaming business, its video games, its digital publishing business. Magic the Gathering cards remain another big one. So Hasbro, the interesting thing here is Hasbro has been beaten up pretty big the last couple of years, but it looks almost like a little bit more of the COVID trade. And this comes right as we got these strange results in GDP showing a big surge in consumer spending. It looks like people are shifting a little bit back from experiences, maybe back more towards goods again. It's a little unusual. Hasbro this morning, stock is up 9.4%, getting a big boom here, up $5.46 to $64.88 a share. Year to date, Hasbro's looking pretty good. Started the year around $50, now around $59. But again, if you zoom out, this thing has been just absolutely crushed over the last couple of years. And the last one I want to talk about, corporate insiders are dumping stock at the fastest rate in more than a decade. And that's always a really good sign, right? All the bad vibes people, the vibe session people who say it's the strongest economy ever, corporate insiders dumping stock at the fastest rate in a decade. That's a good thing, right? Isn't that good? Anyone? Some of you folks in the back? No, it's not a good thing? Okay. Recession fears envelop leaders on the front lines of the economy. What a wonderfully doomy headline from MarketWatch. Corporate insiders have taken a sharply pessimistic turn, selling their company shares at the fastest rate in at least a decade. That's according to InsiderSentiment.com, a website maintained by Najat and John Sehun. The former is a finance professor at University of Michigan and one of academia's leading experts on interpreting the behavior of insiders. The insider indicator that Sehun's calculate is the percentage of all companies with any officer or director transactions for which there has been net buying. The past decade's average is 26%. So on average, about 26% of companies have directors and officers net buyers of shares. At least up until July, that ratio had been slightly to moderately below that 26% average. But in the first 3 weeks of July, however, the insider buy ratio turned deeply negative to 13.6%, the lowest in at least a decade, as you can see from the accompanying chart. And again, this is the percent of publicly traded companies where there is net buying from corporate officers and directors. It is down to just 13% here. And you can see that's lower than we've been in data going all the way back to 2014. and it is falling fast. Corporate insiders are dumping shares. They're certainly not buying. And again, I'm sure that's just a wonderful thing. But you know what? Whatever. Retail, keep piling in. YOLO into zero DTE call options. I'm sure that's going to end really well for everybody. I'm just a doomer. What do I know? I just want to say thank you very much to Viv B for gifting 10 Nobody Special Finance memberships. Thank you so much, Viv, for the generosity and supporting the channel. Guys, if you got one of those memberships, send Viv a thank you. That was very nice. Oh, and don't forget to thank Cole Marsh. Thank you, Cole. Also, thank Viv. Thank Cole for your Nobody Special Finance memberships. If you received one, guys, let him know in the comments. Thank you guys for supporting the channel. And thank you to Mr. Andy Lunchbox with the 2 X's says, I need more Janet Yellen. Well, Secretary Yellen really hopes that the situation in Japan and the unwind of the yen carry trade doesn't lead to people selling my treasury bonds because I'm engaged in a stock buyback program where I sell high interest rate short-term debt to buy back low interest rate long-term debt because that's how an imbecile refinances his mortgage and it's an election year. And you see what I have to work with here between this geriatric potato and this cackling buffoon. So I need to do whatever I can do to juice liquidity in the bond market and make the economy look stronger than it really is. Oh, and have you seen our 2.8% GDP this morning? Apparently it's working. Yes, thank you, Secretary Yellen, and thank you, Andy Lunchbox. Dance Monkey Dance. You want Yellen, you get Yellen. Thank you so much, Andy. Appreciate the super chat. Thanks to Uncle Fedster. Says the charts I'm looking at showing a simultaneous drop of gold, silver, and Bitcoin at 9 p.m. last night. Thoughts? Yeah, you know, I saw that last night at 9. It was around 8, between 8 and 10 p.m. Eastern time is when I saw it. I saw gold dropping. I saw Bitcoin dropping. I saw silver dropping. And I saw the yen surging in value at the same time. My gut tells me somebody in Japan is blowing up right now. Somebody was desperate for liquidity, and they were selling anything and everything they could trying to raise that cash. It could have been Japan. It could have been China. There's some kind of a banking turmoil going on in both countries. You got Norinchukin is having trouble in Japan. I suspect others are. And you've had 40 small regional banks just disappear in China over the last couple of months, being gobbled up by their bigger conglomerate state-owned enterprise cousins. So I think somebody in Asia is probably blowing up. We also saw Deutsche Bank drop 9.5% their stock yesterday off of big loan loss provisions associated with their commercial real estate portfolio, 60% of which is in the United States in offices. So somebody is blowing up overseas, Uncle Fedster. I don't know who it is. I'm on the lookout for it. And now we got somebody blowing up in the States too, because New York Community Bank has taken big losses once again. Also, we got this repo thing going on in Canada. Liquidity is getting scarce in Canada. The Canadian Central Bank has had to inject some capital into their system via repos recently. So there's some tremors in the bond market and in liquidity going on overseas. We're seeing people selling whatever they can sell to raise money, selling off U.S. tech stocks, selling off gold and silver. Somebody's going to blow up soon, Uncle Fester. I don't know who it is, though, brother, but very astute observation of when the sell-offs happened. That tells me it's probably somebody in Asia. Thank you very much also to Metal Seer. No politics today. Thank you, sir. He says, which was tomorrow yesterday. Wow. All right. No politics today, which was tomorrow yesterday. Okay. Thank you for the Department of Contradictions. I appreciate that very much, Metal Seer. Thank you for just being a swell guy and supporting the channel. I appreciate that very much. Going to scratch my head at that one when the stream is over, but we must press on. Steve Woitis says, I see the VIX north of 18. What's your take? Well, volatility is coming back. As they mentioned in that article about the yen carry trade, we're seeing volatility is kind of picking up a little bit. Well, volatility makes the yen carry trade less profitable and more risky, which causes more people to unwind the yen carry trade, which adds to volatility risk. So it could be a little bit of a feedback loop going on there between the yen trade unwinding and the volatility take. Guys, the VIX math, VIX is driven by options pricing. And when you get big moves in the stock, options prices can swing wildly. Also, you got a lot of people who are short volatility out there right now. People have been doing that, picking up penny in front of the steamroller trade. And ask Joe Brown how that one can go. Joe loves to share his stories about what happened during Volmageddon. It's a dangerous trade, and everybody is out there doing it right now. And, well, when volatility starts to rise, they all get out of that trade at the same time, and that causes the VIX to spike as well. So We've seen this before. We saw a similar spike and a similar sell-off in tech back in April. And of course, the dip buyers came in and bought it right back up after NVIDIA reported their earnings. So I don't know if this is like the big one yet. We're still within the range of where we were with that sell-off back in April. So this might just be another minor correction on the march higher to even more obscenely high highs. It could happen. Or this could be the switch. This could finally be the bursting of the AI mania, the unwinding of the yen carrier trade, the bursting of the commercial real estate bubble, the Chinese real estate bubble, all bursting simultaneously. And I think that would just be a party for everybody if that happened. It's going to be a great time. You're going to love it. I don't know, Steve. I don't know, brother. There's a lot going on, and it's really hard to put your finger on any one thing right now and say this is what's causing all of that. Like I said, a lot of stories competing for the headlines this morning. And thanks again, Metal Seer, who says Tesla supercomputer has 100,000, you missed the K there, has 100K H100 GPUs. That's one reason why I suspect NVIDIA's earnings might still be astronomically high this quarter. Because Tesla with their 100,000 NVIDIA H100 GPUs. Now, those were GPUs that were supposed to go they were supposed to go to Tesla. They're going to XAI now. That's one thing they were mentioning on CNBC yesterday, that big data center in Memphis. It's not a Tesla data center. It was supposed to be, but Elon diverted those GPUs from Tesla to XAI. And then he said, should Tesla take a stake in XAI in a Twitter poll? Yeah, companies are still pouring blindly into CapEx, guys. They're still just buying these GPUs up by the thousands. And at $35,000 to $45,000 a pop, that means NVIDIA's earnings are probably still going to be pretty big. But again, it's not so much the earnings as much as it's the guidance, the forecast. Google's still forecasting $12 billion a quarter for the next 2 quarters in CapEx. Most of that's going to go to NVIDIA for chips. So I think NVIDIA maybe has one more quarter, maybe 2 left of this big CapEx, but people are starting to smell rotten here. They're starting to realize, guys, all these promises, none of these promises have been kept. None of the return on investment in these chips has started to pan out. None of these AI companies make money. The hyperscalers make money, but that's only because they're round-tripping revenue with the AI startups. What is supporting this whole bubble? It's just hype. And more analysts are starting to sniff that out. I mean, they're a year late. They should have sniffed this out months ago when I did, but they were all making money off of it. So it's almost like they were paid to look the other way. But yeah, the CapEx is still coming, Metal Seer. So the bubble maybe not bursting yet, but it's close. Darren, thanks again, Metal Seer. Darren from Suffolk says, I smell BS on that GDP number. I do as well. The only possible explanation for that surge in consumption growth is buy now, pay later. Maybe there has been just a huge bump in buy now, pay later usage that has led to tens of billions of dollars of more consumer spending that doesn't show up in the consumer credit charts or anything like that. That's plausible. We're seeing more and more companies offering BNPL. So that's the one scenario where I might be inclined to believe those consumer numbers, but they are suspiciously high. And again, even if everybody was using BNPL, where is that in the data? Where is that in the quarterly earnings reports? I'm not seeing good numbers from consumer-facing companies reporting their earnings. So a sudden reversal of consumer spending like that, it's got to show up in somebody's earnings. Maybe somebody we haven't seen yet. But I too smell BS. Thank you, Darren from Suffolk. I appreciate that. And thank you, JJ. What are you talking about? Says, thoughts if the National Bureau of Economic Research is waiting to officially announce a recession if DJT is elected, even though it feels like we're already in a recession. Look, I don't know that the NBER is that partisan. I was very suspicious that they wouldn't declare a recession back in 2022 when they tried to define their way out. They said, unemployment was still low and therefore it's not a recession, even though we had 2 consecutive quarters of negative economic growth. Well, if we do get 2 consecutive quarters of negative economic growth, that will hit at the earliest second quarter of next year, because we're looking at economic growth right now. So that means at the earliest, this recession could begin in the third quarter, which means you have to have 2 consecutive quarters. So third and fourth quarter would have to be negative, which means we wouldn't even find out about it until late in the first quarter, maybe even the second quarter of next year, which would coincidentally be right about the time the next president, whoever that ends up being, would be inaugurated. So is it politically motivated? I don't necessarily think so. I think there's a lot of BS that's being done at the Treasury Department that is delaying the recession. That I agree with you. I think most people are living in a recession right now. I think 80% of the country is still living in recession, and they have since about the beginning of 2022. But I think the timing, no matter what, I think whoever takes office is going to inherit a recession abso-freaking-lutely. Whether it's politically motivated or not, I'll leave that up to you guys. I'm not going to weigh in on that one. But thank you very much, JJ Watt. And thank you to T.A. Chapman. Says we went a little ham with the Amazon days, part of the consumption, probably not because it was so soon. They cooked the books with the expectation. I don't know about expectations, cooking books. Maybe what you're talking about Amazon Prime Day. That's possible. I'll be honest with you. The consumption numbers, like I just mentioned with JJ Watt's comment, or no, I'm sorry, Darren from Suffolk's comment, the consumption numbers just don't smell right to me. Unless buy now, pay later has suddenly turned into a several $100 billion invisible variable that we can't see. That's the only way I could explain those consumption numbers, because you can't see it. Consumer credit has already started to roll over. The banks have started to restrict the consumer loans that they're issuing. So it's not coming from debt. Wages haven't risen, so it's not coming from earnings. Where would all of this consumer spending, this billions of dollars in consumer spending coming from? Buy now, pay later is my best guess. Thank you very much, T.A. Chapman. I appreciate the super chat, sir. And thank you to Metal Seer once again, a repeat super chatter today. Thanks, Metal Seer. He says, correction, 50,000 GPUs in Tesla Gigacomputer. Oh, okay. So there's two separate ones. There's a 50,000 GPU Tesla data center and a 100,000 GPU XAI data center. There's two of them. So Elon's buying 150,000 of these. Wow. I didn't even realize there was two of those. But what is Tesla doing with them? Humanoid robots, really? I mean, did Elon Musk really say humanoid robots was now the bull case for his company stock? Come on, guys. Like, have you seen? I mean, look, I get it. There's videos of this humanoid robot with the weird looking legs, and it's got the big backpack thing and 100 wires hanging off of it. Are we going to go from that to a humanoid robot displacing human manual labor within a year, within 2 years, within 10 years even? No. What are they talking about there? So what is Tesla using the supercomputer for? Self-driving, the robotaxi, which they tell us is going to be here by the end of the year, even though they said the same thing in 2018. I think the whole point is, guys, they're just dumping billions of dollars into buying equipment for data centers, telling us a thing is going to come around the corner any day now, making them a bunch of money. And when it doesn't happen, they make up something else that's going to be a reason why there's a next big thing right around the corner, right? It was Web3. It was augmented reality. It was virtual reality. It was the metaverse. Now it's AI, and it's robotaxi, humanoid robots. What's it going to be next? I don't know. The electric zipper. Who knows? Whatever it is, these guys have a history of making promises and not keeping them. And for whatever reason, the world keeps buying their stock. I don't get it. Good luck to them. I hope that works out really well for you. And for the last 2 years, it has worked out really well for people. I've been sitting this one out. I'm going to keep sitting it out. I think the end is nigh for the AI bubble. Thank you very much, Metal Seer. And thank you, everybody, so much for all the super chats and the generosity today. A lot of them today, so we ran a little long. Thank you to my channel members, magnanimous melon heads on Patreon and YouTube. You guys are awesome. Links down below to all that good stuff. Shoot, you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.